Good morning and welcome to this Monday, April 6th edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, looks like the market's going to get off to a pretty good start today. Took a look at futures just a little bit ago, and things were looking pretty good, which is good for a Monday because the market has been taking some pretty big hits on Mondays after weekends. But right now we got Dow Jones futures pointing to an open of about 800 points. So welcome relief to the market, which is good news. As far as the news over the weekend, I think partly responsible for the positive start, or at least what looks like is going to be a positive start, was that many countries, several countries, reporting somewhat of a slowdown in the new cases and death rates from the coronavirus. So I think that certainly is giving everybody a little bit of a lift as we head into the week. We're going to have probably a very rough week here in the United States in terms of some of the numbers, cases growing and death rates and so forth. Obviously, there's going to be a lot of eyeballs on New York to see exactly how that progresses. It's going to be a very painful week in New York for sure, and for the U.S. as a result. But keep in mind, the stock market, is when you take a 35% hit in 5 or 6 weeks, you're predicting a lot of bad things. The market's already priced in a lot of this. So we've got to be careful confusing current news with what the stock market does, because the stock market's already been looking ahead. And so a lot of folks will look at the news, see horrible things coming out, and wonder why the stock market, why the Dow Jones futures are up 800, or why the stock market is rising when the news keeps getting worse. Well, part of that is because the market's already priced in, very quickly priced in some awful economic and healthcare news as we go forward. So got to kind of separate yourself emotionally from what you're seeing in the news and what you're seeing in the stock market. That's why I think technical analysis, doing a lot of digging in and researching, find out what's, where the money is rotating. I think all of that's really important. And again, trying to separate that from all of the, everything you're hearing, because we get so much bad news. It's hard to pull the trigger when you're only looking at the bad news or what maybe the things you have to do for the next few weeks in terms of social distancing, staying at home and so forth. But when you're investing your money, you have to realize the stock market's looking ahead. So it's not looking at what we're going to be facing here over the next couple weeks or even couple months. It's looking out to the next 3, 6, 9 months. And so if we're starting to see some of the improvement around the world, and we know a lot of the same social distancing measures are in place here in the US, we can kind of predict with some certainty how this thing is going to go. And I think the market is beginning to see a little bit of light at the end of the tunnel. At least, it's still way early, but at least we're starting to see a little bit of good news. And I think that is helping to send the market higher. Let's take a look at the market and what happened on Friday. I did change my candle glance charts here a little bit that you'll see. So on each of these charts, I just have a 5-day chart right now. So I'm not going back very far. I just want you to see how each of these different areas, the various indices and sectors, have looked over the last 5 days. So here you can see the Dow Jones Industrial Average on Friday was down about 1.7%. We did get a nice little uptick though, right at the last, probably 15 minutes of the market. We cut into a lot of the losses. I think the Dow Jones probably cut 1.5% off in just the last 15 minutes. Same goes for all the other indices. The S&P 500 down 1.5%. NASDAQ was down 1.5%. Mid caps and small caps also got that rally at the end of the day, but still on a relative basis, these two areas getting hit hard. Mid caps down 2.7%, small caps down 3.55%. And if you just look at these 5 days, you can see that the Dow over the last 5 days actually set a low at the beginning of the day on Thursday. The S&P more at the end of the day on Wednesday. Same goes with the NASDAQ. But look at the mid caps and small caps continuing to put lower lows into Friday. Small caps quite a bit. So yes, we rallied nicely into the close, but that underperformance by small caps continues. and it's really been by a very wide margin. So as bad as it's been in the S&P 500 and Dow and NASDAQ, it's been a whole lot worse in mid caps, especially the small caps. Turning our attention to sectors, you can see consumer staples. Staples in healthcare have continued to be very strong performers on a relative basis among the sectors. And so a lot of my trading personally is coming from these two groups. Staples and healthcare. Staples, anytime the market goes down or is fearful, tends to be an outperformer. But I think, there are certain areas because of the reason for this decline, being a healthcare concern, I think that is allowing many of these companies that sell household products that, help to protect, any antibacterial products, things like that, are even more in demand. People are stockpiling them. So it's not just that they buy them because they need them. They're buying them to stockpile them. So a lot of the companies getting a tremendous boost in revenues, both from online sales and from in-store sales. Healthcare, again, because this is a healthcare crisis, number of the companies, pharmas and biotechs in particular, doing very well. So these two groups, not only were they among the best performers on Friday, but they've been among the best over really throughout this crisis, last 6-7 weeks. So staples, real estate, and healthcare all did well on Friday. Real estate has struggled quite a bit. And I don't know that this is a group that I'd be pouring right back into. I think there's going to be a lot of changes coming out of the coronavirus, this crisis, and the way we approach things going forward. I just think they're going to be a lot more people are more health conscious, more germophobic, if you will, and it's going to probably remain that way for the foreseeable future. Even if our social distancing measures work and we start to see caseloads drop and the death toll drop or slow in coming days and weeks, I don't think this is something that's going to go away anytime soon. Many health experts are saying that even if we get this under control in the short term, we're probably going to see another surge in cases again when the weather gets cooler. That's just typical for a respiratory flu. And so, again, I think some of the changes that are being made right now is not something that's going to change drastically over the course of the next 6 months, maybe even 12 months. Beyond that, we'll have to see, but I believe that there's going to be a paradigm shift. I think that people will be much more conscious, health conscious for an extended period of time. And so staples and healthcare are likely to be beneficiaries of that. To the downside, utilities not doing well, had a rough time on Friday, down 3.5%. Materials down 2.4%. You can see of these 5 sectors, the only group that actually went to new lows on Friday were the material stocks. And partly, or part of that could be blamed on the strengthening dollar again. The dollar was rallying. Just to show you this pretty quickly. But the last few days of last week, actually throughout much of last week, you can see a big rally in the dollar. So as a result, that put a little bit of pressure on materials. Energy didn't do as poorly because crude oil prices had a pretty nice week last week. If I show you that real quick. You can see crude oil prices, big bounce. We were down around $20 a barrel, gained almost 40% in the last 2 days of last week. And from the lows back at the beginning of the week, it was more than 40%. So really big move in oil. We had not seen that since the big collapse started from $65 a barrel. But that was a pretty nice move in crude oil prices. And it resulted, when you look at the energy group, energy's been bouncing back pretty nicely after really struggling. We did actually go back above those, I guess it was the March 26th rebound. That's where we saw most of the gain in the S&P 500. Here's that rally. And the S&P has pulled back off of that 3-day rally. But when you look at energy, energy's continued to move up and above that prior high. Now, I suspect that energy is going to struggle here at the 20-day moving average, probably will not keep pace today. I wouldn't even be surprised if it pulls back. When I looked last, crude oil prices right now down 4% today. So probably we're not going to see energy participate in this rally. It'll likely be some of the other areas that I've already spoken about. All right, let's keep moving on here. And let's take a look at the 10-year Treasury yield. An update here. Well, we closed on Friday at 0.59%, but you can see the steady downtrend. And when the 10-year Treasury yield downtrending, it means Treasury prices are uptrending. So money is still fearful. And that's going to continue to keep a lid on equity prices. Now, when I say a lid, doesn't mean we can't have moves up. You know, we saw the yield rising, which would indicate, hey, we're going to have a really good period of time in equities, and that never really happened. There's a tremendous amount of fear still in the market. So even moves back to the upside in the 10-year Treasury yield and folks selling treasuries, that's why you would see the yield moving up. That money, a lot of times, is just simply going into cash. There's still too much fear for folks to pour into equities, but we do have some things that we want to watch for. First of all, the S&P 500 got its initial bounce, and we've got the major low in place. I don't know if that's the ultimate low. I think the odds at this point are pretty strong that we have bottomed. I'd like to see a double test, a double bottom from a technical perspective, setting a bottom, getting a bounce, which we saw. You know, these other bounces were not really bounces. And I'm going to stretch this out just a little bit further. But if we just go out like 40 days instead of 30, you can see we've had a couple. Here was 2 days, but that was early on when we were still up around 3,000 level. This, for the most part, was a straight down drop with just a couple of days buying late in the day where we saw some decent rallies. This has been more of an extended move. And this low right here came with a volatility index. Actually, just before that low, we saw the volatility index getting up to 85. Monday, when we hit the low on the S&P, that's when we actually saw the VIX move up to about 70, but be below this double top. So as we were breaking to new lows, let me go back to that S&P 500 chart. As we were breaking to these new lows, we didn't see nearly as much. We didn't see as much fear in the market, and that was somewhat consistent. I'm going to show you a chart here. Let's get into this daily chart of the VIX, and I want to go back and show you. I'm going to go all the way back into 2008 and through 2009. You remember on the S&P, and I can even add this in so everybody can see it, and we don't have to guess. I don't have to tell you to remember. I can just show you. Okay, so remember back in 2008, October, here's the VIX spiking up to 80, 90. Here was the low. November, put in a new low. Again, we spike up to 80, right about that equal high. So fear was still there. When we ultimately set that March low, when we broke down below these prior lows, you see how we created this low with a much lower level of fear? So the volatility index at this point was only in the low 50s, which was still a very elevated level, still very fearful. But you can see how the fear was subsiding. When you start seeing lows print with less fear, that to me tells me that maybe the worst is behind us. And so again, when I go back and we look at the other chart, get this back up here. All right, so when we see the S&P 500 going down here and putting in this lower low and breaking below the March 18th low, and then you see the VIX, which is much lower. So here's your double top fear with the lows, and then we go to another low in the S&P, but all of a sudden, there's not as much fear. When the fear starts to dissipate, you're not going to take out a bottom when you've thrown the kitchen sink in. You know, everybody's fearful, extreme levels that we really have never seen or rarely seen in the market. That tends to print major stock market bottoms. Again, 2008 into 2009, we saw one more low, but with less fear. Are we going to see another low? I don't know. I would say the chances are less than 50-50 that we're going to go to a new low. I know there's a lot of bearish people out there right now. I think it's, certainly makes sense to be cautious. But if you had gotten out of the market at 3,000 or 3,100, something like that, when we first started this drop toward the end of February, and you're wondering, maybe should I get in? I think that, given what's taking place now here over the last couple of weeks, I think it's starting to tell me more and more that we have a bottom. I wrote a couple articles over the weekend. If you didn't get a chance to take a look at them, you might go back and look. In my Trading Places blog yesterday, I wrote a Making the Bullish Case for Equities. And I started off by saying that, if you're going to argue the bullish case for equities right now, you're going to be in the minority. Everybody thinks we're going to get a double bottom, maybe even go to new lows. And some people even worse than that. I've, read some articles that, hey, this is the start of another depression. I don't believe any of that. I think that we're going to recover, and I think the recovery is going to surprise a lot of people. The question for me is whether the bottom's in and we're rallying from here, or do we need some more movement to the downside? That's still up in the air, but I am seeing a lot of signs that are telling me that the bottom is probably in. This chart right here I thought was really telling. Back in the secular bear market in from 2000 to 2012. Some people are saying the bull market started in 2009. Technically, it did off the low. But a secular bear market does not end, to me, until you break the prior highs. So that occurred in 2013. So when I talk about a secular bear market, I talk about the top. And you can see a little false breakout here and then back down. A little false breakout here and then back up. Market's always trying to shake out, folks. So you think you got a breakout here. Nope, you're wrong. And if you got in, look at what you had to suffer through. Here, false breakdown. So you're getting out, wrong, we're rallying back. Take a look at what we just did. We had a lot of fear at the end of 2018. That doesn't seem like much fear now compared to what we've been going through recently. But it was a pretty fearful period at the end of 2018. Mostly, all from a financial standpoint. Now the fear is as much health related as it is financial related. But this fear at the end of 2018 was pretty big when we compared it to anything in the prior 9 years, 10 years. But we bounced off of that, went to new highs. When we came back down this time, look at how we went just a little bit below. See how we went just a little bit below? Really scared a lot of folks. I had done an analysis where I connect these highs and I dragged that slope of the line down to connect this low in 2009. That intersected right at about the 2350, 2400 area where we had this low. We went just a little bit below and then bounced back up. I think it's really possible that we've seen the low. I would be better with being in part of my position. And I'm not right now. Personally, I'm not. But I would be okay. If you were in last week or you've been in or you've been slowly building position, I would be feeling much better about that strategy than I would have, say, 2 weeks ago. Even though I would have been doing it from a longer term perspective, building up as we get lower and lower, I would still think that that's the way to go. But I didn't feel as comfortable that perhaps a bottom is in. And now as I see the way the market's acting, I believe more likely than not that we are not going to go back and close below that 2190, 2200 area. But we'll see. Maybe things change. And as fast as the market changes these days, maybe I'll be eating my words by the end of this week. But for right now, I would say the odds are that bottom is going to be a pretty important one to watch. If we fail to hold that bottom and we see that volatility index shooting higher again, I fully believe 1600 to 1800 could come into play. Because when you get a panicked market, first just throw out, being rational. The market's never rational. So worst case scenario, I could see 1600 to 1800. That would be a 50% drop from the 3400 level in a very short period of time. And I would have to say that would definitely mark a bottom. But let's take it one step at a time. For right now, and we're going to continue to watch this every day, I think we're probably in pretty good shape here. Now, the other thing I looked at, and I wrote this in the Don't Ignore This Chart blog yesterday, did a lot of writing over the weekend. Also, the weekly portfolio report out to our members. I've been doing a lot of analysis in the market. So there's a lot of things that can be done, even if you're not doing a lot of trading, which I have not been doing. There's still a lot of things that can be done. But in this article, I talked about some of the areas that have really gotten hit hard. You know, as you look last week, the S&P dropped 2%. Mortgage REITs dropped 35%. Recreational services, think cruise lines, that whole area down 29% last week. Mortgage finance, 24. Airlines, 23. Furnishings, 22. Hotels, 21. Home construction, 17. Transportation services, 17. Many of these same groups that got hit on the first move down, with a little bit of weakness last week, all of a sudden all the selling again comes into those groups. These are the areas I would be very careful with. Yes, you can get some quick bounces, but when the market just gets a little weak, you can see how quickly the sellers appear again. These are groups that are underperforming, likely to continue to underperform for a while. I would be careful, very, very careful with these groups that the market is shunning. There's going to be many of the areas that are they're going to struggle to come back. Other areas will come back quicker. So what areas look good? Well, here was about the best I could do is tell you over the last month, here are the top 15 industry groups. Broadline retail, toys, mobile telecommunications, non-durable households, pharmas, truckers, gold mining, biotechs, mining, delivery services, food products, telecommunications equipment, food retail, medical equipment, and drug retail. There's your 15 areas. Of those 15, for me personally, I'd be most concerned about the gold mining and mining, because I don't think that's a paradigm shift. I think that's strictly a shift because of fear. And if the market bottoms and we start moving up, I think these are two groups that will underperform. The other 13, however, I think the Wall Street is telling us these are areas we really want to be paying attention to. And so most of my trading candidates are going to fall probably in 13 of these 15 groups, excluding gold mining and mining. I think this is where you're going to find a lot of really solid trading candidates. And within that, I think we can go and look at some things like relative strength. Look at accumulation distribution, some of the things I've been talking about here probably over the last month or so. I've just changed my way of looking at the market, and I want to be involved in some of the stocks that make a lot of sense. All right, so individual stocks. Let's talk a little bit about some stocks in the news. First, got to mention Zoom. This was one of the stocks that I really liked, and I went on to The Pitch, which was a show sponsored by Stock Charts TV, and I joined Mary Ellen McGonigal and Grayson Rose, and we each offered up 5 stocks that we really liked, 5 themes in the market. And one of the stocks I mentioned was Zoom, and the stock has really struggled since I talked about it. I don't think the area of the market is struggling, but Zoom has come out with security issues in their product. And so it's going to be really hard for them to compete against other companies, even though the environment is great for a lot of folks using their technology. The company is struggling right now because of these security flaws. And so Zoom, I know in pre-market, was getting hit today. And one of the things I've been doing a lot of times is trading on the open, because going back to that accumulation distribution, you can see pre-market Zoom down $14. I saw some class action lawsuits filed. I think the stock was downgraded today, and they've got some real business issues that they've got to deal with. If they're going to be a leader in this space, they have to resolve those security flaws. Now, another company in this space, if you like the whole theme, which I do, pay attention to Ring Central. Ring Central up $5 today. This is a company likely to benefit from Zoom's security issues. And it's in the same space, similar space, a lot of online collaboration, meetings, and so forth. So keep an eye on Ring Central. When we pull up the two charts, and let me show you the difference here. Let me show you the difference in accumulation distribution, what's been taking place over the last week. Actually, maybe even the last 2 weeks. You can see Zoom, the accumulation distribution, you can see the volume, huge move up, relative strength was off the charts. But here in the past week or so with these, maybe 2 weeks, with the security issues, you can see the accumulation distribution has been dropping. So with this gap down, what does Zoom do today? If there's a lot of accumulation, then I like it much more than if we see a gap down and continuing selling. Because if we close near the low and we have big volume, you're going to see this accumulation distribution continuing to move lower. So Zoom is one that still is in a good space, but they've got business issues that they're going to have to deal with. Ring Central, on the other hand, does not have those issues at this point. And look at the accumulation distribution continuing to move up near near highs. So in the very short term, if I'm trading these two stocks, I'm probably going to be looking more at Ring, just because the market's telling me to look more at Ring. Let Zoom iron out their issues, or at least let's start seeing that accumulation distribution turn up, so that we don't have as much fear worrying about whether or not the stock's going to be bought throughout the day. All right. Let's see, another story. Kraft Heinz, KHC. All right, so Kraft Heinz came out. They said that they're adding shifts at plants that make packaged foods such as macaroni and cheese. Who doesn't like macaroni and cheese? Due to a spike in demand stemming from stay-at-home orders. Well, if you're staying at home and you've got kids at home with you, macaroni and cheese, yeah, that works. KHC, a beneficiary of that. Now, even though we've been moving down over, throughout February and putting in that new low in March, look at the accumulation distribution turning higher. So this is a stock that I think is definitely benefiting. Not only is it a staple stock to begin with, which helps, but it's increased demand. I mean, these are the types of products, macaroni and cheese, you're going to stock up and put them in your freezer. So KHC, I think, becoming a beneficiary, and now, they're talking about they're adding shifts to make even more. That tells us that demand is exploding. Boeing been a very difficult stock, but we saw a huge move up. That just led to more selling. They are extending the suspension of its Washington production operations. JetBlue said that they are burning through $10 million a day right now. They have only 7,000 customers flying each day compared to the typical 120,000. 7,000 a day versus 120,000. I don't know how all this is going to play out in the airlines. There's probably going to be mergers. There's going to be bailouts. They're going to have to survive. I just can't see all of these airlines making it through. Trying to pick out which one is the best. I would be looking at the relative charts. Wall Street will tell you which ones. JetBlue, airlines relative to the S&P going down. JetBlue's been kind of all over the place in terms of, relative to its peers. Look around, look at some of the others. Look at Southwest versus the airlines. See Southwest doing much better. I think Southwest, the market is saying this could be one of your winners. You look at a company like Delta Airlines on a relative strength, not so much. This was a company back in, early March setting new highs. Then 2 weeks later, it's setting new lows relative to the airlines. You want to be careful with that. So if I was even considering airlines at all, I would be thinking about something like Southwest. Look for relative strength. Whether you're looking at good groups, industry groups, or bad industry groups, I would still always look for relative strength. Wall Street is giving us signals. We got to be prepared to take those. All right, we're going to get ready to wrap this thing up. Why don't we go right into the three you must see here. So I'm going to bring up first a company that's been getting beaten up, but its accumulation distribution looks pretty decent. We pulled back last week, but we did rally on Friday, started to turn back up. But as we've been moving lower, we've actually been holding pretty well in the accumulation distribution. And then once the buying came in, we set a new high. So this is EGHT, And if you look at the relative chart, this is in the fixed line communications. And fixed line communications started out pretty strong first half of March, but has really pulled back. This stock has shown a little bit of relative strength, pulling back, but I do like that accumulation distribution and their rally on Friday. I'd watch that 12.5 area to the downside, but I think this is a stock that could benefit short term. A couple of others that showed some pretty good accumulation distribution. How about Edwards Lifesciences? This is in the medical supplies group. Medical supplies, not bad relative to the S&P. Edwards Lifesciences starting to show some relative strength to medical supplies. And during this pullback that you see, I'm going to show you the accumulation distribution. Look at setting new highs. A lot of hollow candles. So it gapped up earlier today. We just got the open here, starting to pull back. But this is a stock that if it goes into negative territory, could be one to keep an eye on. Finally, PRGO, last stock. Perigo, it's in the pharmas. Looks on the surface, not very good here. Going down, sideways consolidating, actually setting a new low on Thursday. Look at the accumulation distribution though, still up near the high. So even though this is a stock that maybe is underperforming its peers, it has not fallen apart on an accumulation distribution basis. Got a nice gap up today. Let's see if we can get through that 20-day moving average, but PRGO could be a little sleeper in the market right now. Quick update, and then we'll wrap this thing up. The market currently up 800 points. Dow Jones up over 800 points, almost 4%. NASDAQ 3.7. Volatility index down a couple to 44, getting much lower. That's a good sign. And if we start to sell off, another thing to look for is, does that volatility index really spike? I mean, are we really truly fearful on this next selling binge that we have? If we go back down to those prior lows, does the VIX top out at 50 or do we go back up to 80? That's going to be one of the clues that we're going to watch for if there is another push to the downside. Like I said at the beginning of the show, we could be simply seeing a bottom and maybe a little bit of consolidation as we start to work our way higher. Going to be interesting. I think I said last week, this week and next week are really going to give us a lot of clues about what we can expect further down the road, not just in terms of the number of cases and how the social distancing is working here in the U.S., but I think the stock market's going to be telling us a lot about what we can expect going forward. So let's pay attention to the signals that are coming out. Everybody stay safe out there. Continue to follow those CDC guidelines. And let's come out of this stronger on the other side than we went into it. Everybody have a great day. I'll be back at Stock Charts TV tomorrow for your next Trading Places Live. Take care, everybody. Happy trading.